Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about Chevron, which as we can see over the last year, this stock is down 11% while the rest of the market is up 21%. But that being said, it might not necessarily be all bad news as we'll see in this video. So I'm going to look at their financial results and then also try to value their company using a DCF model. But before I get into that, let's talk a little bit about Chevron's business model and how it is that they actually make money. So Chevron was founded in 1879 and it is the second largest energy company in the US after ExxonMobil. Chevron makes money selling crude oil and natural gas produced in the open market to over 180 countries all over the world. The business operations for Chevron are broken up into two segments, Upstream and Downstream. The Upstream segment of Chevron is responsible for exploration and extraction of crude oil, natural gas, and natural gas liquids, with their large team of scientists and engineers. They use seismic imaging to peek into the earth and find places where oil and gas might be hiding, and then they drill wells to extract these resources. The downstream segment of Chevron is responsible for refining the crude oil into finished products like gasoline for our cars, heating oil for our homes, and aviation fuel for our planes. Chevron's most important assets are the physical assets used to extract and sell crude oil, as well as their brand reputation, which differentiates them from other less trusted brands of energy production. And lastly, this oil and gas is sold through Chevron's retail service gas stations and also on their website direct to consumers. So now we can get into their financial statements, and as we can see right here, they're really not that optimistic. We can see revenue was about $54 billion in the third quarter of 2023, down 18% from $66 billion year over year. And we can also see for their earnings results here, net income was about $6.5 billion, which is down 41% year over year from $11 billion. And if we go to page 10 here, we can see their cash flow statement. They had operating cash flow of about $9.7 billion in 2023, which is also down from $15 billion in 2022. Mainly all of these revenue, earnings, and cash flow results are down from 2022 because a lot of these oil companies had a positive boost from the war in Europe at the moment, or a lot of the wars happening in the world right now. And obviously, when there's war, oil prices go up because people want fuel for their weapons, and these oil companies end up benefiting from that price surge in oil and gas prices. But now that prices have sort of trickled back down to where they used to be, these revenue, earnings, and cash flow results are sort of normalizing and going back to where they used to be compared to these outlier numbers in 2022. We can also see in the third quarter for their financing activities, they had cash dividends paid out of about $2.9 billion, and they also repurchased about $3.4 billion worth of shares. In the fourth quarter, we can see for their revenue, they had about $47 billion of revenue, which is down 16% from $56 billion. And they also had about $2.2 billion of earnings, which is down 65% year over year from $6.3 billion. And then if I scroll down to page 10 again, we can see their cash flow statement for the fourth quarter. They had about $12.4 billion of operating cash flow, which is basically the same as it was in 2022. And then we can also see they paid out cash dividends of about $2.8 billion and repurchased about 3.4 billion shares outstanding. If we look at the other side here, we can see their results for the full year. They had revenue of $200 billion in the full year of 2023, which is down 19% from $246 billion in 2022. And they also had net income of $21 billion in the full year of 2023, down 40% from $35 billion in 2022. If we look at their cash flow results for the full year, they had about $35 billion of operating cash flow, and they also repurchased about $14 billion of shares and paid out $11 billion of cash dividends. This comes out to about $25 billion of value or of cash returned to shareholders in a year where they had operating cash flow of $35 billion, and they also invested about $15 billion into CapEx. So after subtracting CapEx, it looks like their free cash flow was about $20 billion, which means that they basically returned more value back to shareholders than they made in the way of free cash flow. So obviously, cash flow return is one of Chevron's primary goals here, even more so really than ExxonMobil, which, as we saw in the last video, also returned a lot of value back to shareholders, but not more than their total free cash flow, whereas Chevron here returned even more value back to shareholders than they had in the way of free cash flow. Lastly, for their balance sheet here, we can see I'm using the results for the end of September 2023 because the end of December hasn't really come out yet. And then we can see right here, total assets were $263 billion, total liabilities of $97 billion, and total equity of about $166 billion, with retained earnings amounting to about $200 billion. So now we can see their DCF model to try to value their company. I'm using a growth rate of 8%, which I got from their free cash flow growth for the last 5 years. In 2019, they had free cash flow of $13 billion. In 2023, it was about $19 billion. So compounded annually, that comes out to historical free cash flow growth of about 8% year over year. So I'm using that as the projection for the next 5 years. And then to calculate the DCF model, I'm using a weighted average cost of capital of 7%, which I got from this calculator right here. Basically, I calculated the cost of equity using these metrics here, came out to about 10%. Their interest rate on their debt was about 2%. So if you multiply the interest rate on their debt to their debt proportion and then add that to the cost of their equity multiplied by their equity proportion, and then you also multiply the debt proportion by the tax shield because debt is a tax write-off, you end up with the 7% WACC metric here. Then with these metrics, about $14 billion of debt after subtracting cash, and then about 2 billion shares outstanding, you get an intrinsic value per share of $178 per share, which means that Chevron is currently trading below intrinsic value per share at $151 per share. Obviously, this is good news, but compared to ExxonMobil, which we saw in the last video, it's not nearly as impressive because Exxon's free cash flow growth over the last 5 years was about 40%, and they were trading at a much steeper discount compared to their intrinsic value compared to Chevron. But as we'll see momentarily, Chevron does beat out ExxonMobil in one area, which is in dividend yield. We can see Chevron has some of the lowest profit margins compared to their two competitors here, Exxon and ConocoPhillips, but they do pay a higher dividend yield than the two companies at 4.05%. So even though Exxon was trading at a better share price compared to their intrinsic value, it looks like Chevron is paying out a higher dividend yield. So if you're focused on dividend, you'd probably want to give it to Chevron. Lastly, we want to compare Chevron to some of the other companies we've looked at on this channel. Chevron was trading at 85% of their intrinsic value. Exxon was trading at 12%, so you can see the stark contrast there. But nonetheless, trading below your estimated intrinsic value per share is still very good news. Then we can see for growth rate, Chevron was not really that impressive, coming at about 8%, so not good enough to get onto this table. But for dividend yield, they come in second place, pushing ExxonMobil down to third place with their 4.05% dividend yield. Then for gross profit and net profit, Chevron's profit margins weren't that impressive. They're 15% and 10%. Not good enough to get onto these tables. You can see the top 10 companies that we've looked at in the videos that had the best gross profit and net profit margins. And then for Q3 year-over-year revenue and earnings growth, it looked like Chevron actually had a revenue decline of 18% and earnings decline of 41%, which did beat out Tesla's earnings decline of 44%. So they do get onto the 10th place spot so far for year-over-year earnings growth. Lastly, for stock performance over the last 5 years, Chevron is up 29%, which isn't good enough to get them onto this table. Tesla had the highest at 850%. So let me know in the comment section down below what you guys think of Chevron. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.